Welcome to this week's edition of Arkansas Money Talk, brought to you by the team at Retire Path Wealth. I'm your host, Kristen Oakley, and I'm in the studio today with Dale Colclasure. He is the president of Wealth Management, and Mark Smalling, who is the president of Insurance Management at Retire Path Wealth. It's good to see you guys. How are you this week?
Oh, very excellent. It's great to be back.
Lots going on.
I know, a lot going on. And you, Dale, have an upcoming wedding in the family, correct?
That is correct. I have a child getting married this summer.
Yes, so father of the bride, right?
Yes, ma'am. Second time through.
Are you ready for it?
We have to be.
Right. I bet you'll make a wonderful father of the bride for sure. Well, we are going to talk today all about taxes. That is such a key, important subject, and it's so much in the forefront of people's minds right now with the upcoming sunsetting of the tax code in 2025. Right. Now, a lot of folks, I think, it's interesting. We stress about taxes, and we've talked before about how a lot of firms out there don't engage in the type of strategic tax planning that you at Retire Path Wealth do. So take it away. Where do you want to start off with this whole tax discussion
Kristen,
today?
It's not just that they don't discuss it, it's they're prohibited from it.
They are not allowed to.
That's absolutely correct. It's so many times that, the thought is, oh, doesn't my CPA do that for me? The idea of an accountant, by definition, is simply just accounting for what you've already done, not necessarily looking forward. Now, plenty do, but it has to be a request that's asked, and then they have to have time because they can't do it during prep season and they can't do it other times. It's something that needs to be done, but it's definitely one of those things that is going to take a large bite out of your income, and especially with most people's nest egg being in some type of a qualified plan, you have that unspecified partner that's out there with you is the IRS, who's going to get a piece of every amount that you take out, unless you've properly planned in advance for those distributions.
Well, let's take it back to basics and start with tax brackets, because I think there's a lot of confusion out there about that too, right?
But there's a lot of misconceptions. I mean, it's interesting how many times people come to the office and we're sitting there and they're going, "Well, I don't pay taxes. I get a refund every year. I don't. I mean, that's what they don't understand how tax brackets work. They don't, just because it's being taken out of their check. They don't think about it. They're not writing that check.
We're not taught this stuff, right? I mean,
that's exactly right.
I think they make it confusing on purpose, right?
Well, we're intentionally left ignorant when it comes to this, and so basically, so many people's opinion is it's just what it is. I mean, it's I save up all this stuff, I turn it in at the end of the year, and then my CPA comes back and tells me what I owe. I just don't want to have to write a check. That's always seems to be the initial response. And it's simply because we're not taught how these things work. And then even people that do understand the concept of brackets, where there is a 0 tax bracket, there's a 10, a 12, a 22, and a 24 today, is their thought is as I go through those, all of my income is taxed exactly the same way, which is also not true.
Right, so unpack that misconception, because I think that's a false belief that a lot of people hold.
Right. Yeah. The way we try to look at it is brackets are kind of like buckets. And so I have a bucket, and when it gets full, it flows over into the next bucket. But everything that remains in that bucket is still taxed exactly the same way. And so one of the abilities that we want to look at is to take the opportunity to help people understand, and roughly in 2023, if you're married filing jointly taxable, you can have up to about $120,000 of gross income and still be in a 12% or lower tax bracket. If you fit there, your marginal taxes is really only about 7 to 8% is what you're actually paying at that point, just depending on what sources of income you're using outside of that.
So this current tax code, though, we hear this phrase, it's set to sunset in 2025. What does that actually mean?
Well, what that means is that if nothing's changed by Congress and Congress doesn't enact a new tax code between now and then, that it's going to sunset and go back to what the tax code was prior to that in 2016.
What were the brackets then?
Yeah,
well, and that's one of those things that's always interesting, and not to step forward to that, but I've always loved how anytime a tax cut is imposed, they add a sunset provision, but whenever they add tax spending, they never sunset that.
Yeah, isn't that interesting?
But to answer your question that you asked, Kristen, we'll go back, is basically on January the 1st, 2026, we revert back to the 2016 tax codes, which the 10% brackets basically stay the same. A 12 becomes 15, a 22 becomes 24, and on and on and on. And a lot of people sit back and go, when we have these conversations in in meetings or in seminars when we're presenting this fact, they're like, Dale, what's it, 12 to 15? That's not that much of a difference. That's only a 3% change. Well, where they haven't actually thought about the difference is realistically, that's a 20% jump in taxes because we've gone 3 to 12. Or 25% increase. And so it's a substantial amount more I'm going to pay on every dollar that comes out above and beyond that. And then one of the risks that so many people haven't prepared for if they haven't put together a written income plan is the fact that at some point when RMDs come in and they're forced to take more money out of their 401k plans, they may be forced into the next bracket, which simply shrinks their pot of their nest egg even greater and puts a greater strain on their income.
RMDs are something I'm personally very passionate about, required minimum distributions, because I've had several conversations with folks who have not even heard what this acronym is, what it stands for, people who are nearing retirement. So explain a little bit about why that's so critical. I know you touched on it, but for folks who are watching at home, explain how these RMDs work and why they can be so problematic to your overall retirement plan.
Okay, it's one of those things that, have this conversation many times with clients and potential clients, or if they love their IRA account while they're accumulating because I don't have to pay taxes on those dollars.
Right, because it's tax deferred. So we're talking about 401ks, 403bs, IRAs, right?
Yes, and multiple other accounts that are going to fit that same categories. But then all of a sudden they've got their income needs met, and then they're going to hit this magic age, which again Congress has changed that with the Secure Act 2.0
right?
again.
Yes.
They slide those in at the end, and so some people now won't be required to take those until 73 or 75 now.
Right.
But all of a sudden you have this new stream of income that comes in and just screws up the tax plan that you had in place to begin with.
And it screws it up because now you're bumped up into a higher tax bracket potentially because it's taxed as ordinary income, right?
That is correct. That is correct.
Yeah. So gosh, so much planning needs to go into this for sure.
That's exactly right. And so kind of just as Kristen has pointed out, if you're out there today and you don't understand the effect that distributions from your IRA account or the fact of required minimum distributions are going to have on your future income flow, I absolutely invite you today to call the number or to scan the code, to set up your complimentary consultation, to come in so that we can help you understand how taxes work in your situation by working you through our written income plan process and getting you on your own Retire Path plan.
Dale, Mark, thank you so much. To our viewers at home, we are going to take a quick commercial break, but we encourage you to take advantage of this opportunity. Call the number on the bottom of your screen, 866-724-3893, to schedule your time to come in and meet with Dale and Mark and the team at Retire Path Wealth. This is completely complimentary. For no cost, no charge, no obligation, they're going to be able to sit down with you and put together a comprehensive, holistic financial plan for your retirement, which factors in all of these important considerations regarding taxes. Now, when we come back, we're going to be talking about some of the strategies that can be employed now before the current tax code sunsets, so you're not going to want to miss it. Stay with us.
Good morning, Ben.
Good morning, Ben. Hey, birthday party for Carol and 5. Happy birthday to you.
Good morning, Ben. Happy Monday.
Daryl's birthday, be there every square. Happy birthday to you. As you can see from our quarterly report on slide number 62, we're trending in the right direction. All signs point to a very positive outlook for the next several years. If you peel back the onion
Ben, do you have anything to add?
The work never seems to end until the day it finally does. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Well, welcome back to Arkansas Money Talk, brought to you by the team at Retire Path Wealth. I'm your host, Kristen Oakley, and I'm here with Dale Colclaser and Mark Smalling. And gosh, we are having a lively discussion about all things taxes today. Such important information to note. And before the break, we were talking about RMDs. And I know there's something else you want to mention about these required minimum distributions.
Right. Yeah. I mean, there's not only a required minimum distribution, something that people have a tendency to dread, but there's also some advantages that come along with them.
Okay, so yeah, talk about those, because I think
okay.
most people refer to as really mean and dastardly, or
Right. Well, basically at the same age that you would have originally been required to take a required minimum distribution, everybody qualifies for the one tax break that fits in with that, called a qualified charitable distribution. And so the idea is if I take money directly from my IRA, contribute it to my charity, whatever that may be, not only is that money not taxable to me, it doesn't even count into my income calculation. So there can be some great advantages to be taken care of or taken advantage of at that point. But again, typically only if we've planned in advance for those.
Absolutely. Well, so the QCD for the RMD equals a win-win situation for both, right? For
yes,
you
ma'am,
and
that's
the
right.
charity as well.
Right, and we have many of our clients using that every year, and if you're, especially if you're using the standard deduction, you're, as your deduction and you're not itemizing, you're able to take advantage of that, because if you're using the standard deduction, your charitable contributions, a large part of them are not tax deductible anyway. So
Right.
that way you can actually take advantage of both of those.
Well, we've also talked today about why right now is a unique time before the current tax code is going to sunset in 2025. And I know there's a lot of strategies that you are currently employing for your clients to take advantage of what really a lot of folks are saying, taxes are on sale right
That's
now,
right.
So talk to me about some of these other strategies that you're able to employ in addition to these QCDs.
I mean, one of the definite opportunities that we're attempting to take advantage of is the ability to aggressively go after qualified money, which again, those are all of your IRA accounts, 401ks, anything that's going to be fully taxable upon distribution, and trying to utilize to the maximization of the tax bracket that you're currently in, possibly even a tax bracket higher than that, even in some cases makes a lot of sense.
Right.
Where the idea of paying those taxes today with a known amount of what we know the tax liability is going to be, yes, and we'll go ahead and get the monkey out of the room.
Right.
Yes, you're going to pay more today, but the idea is to know and understand the benefit of paying less to none later. Not just necessarily for yourself, but if there are any assets that you have that would be legacy assets that you're going to pass on to the next generation.
Meaning an inherited IRA that you would pass on to, let's say, your children, for
That is
example,
correct.
right?
If you have the ability to pass on a Roth inherited IRA, your beneficiaries can stretch that no tax out for another 10 years after that.
For sure. So this term is Roth conversion. I'm hearing this a lot. So walk someone through if they think, oh gosh, this might be something I need to pay attention to. I need to come in and meet with you guys. How would this process work for them to enact a Roth conversion?
Well, and what they do is that if they have a qualified plan at work, you actually have to first move it out to a traditional IRA.
Right.
To
Called
then
IRA rollover.
an
right?
IRA rollover, and then you can actually convert it to a Roth and pay the taxes on the money at that time. But a lot of people come in and are confused because if they've made too much money, they haven't been able to make a Roth contribution.
Right.
But a Roth conversion doesn't have an income limit on that.
And you all handle all the paperwork and all of that, right? I mean, I can imagine if someone's listening at home going, okay, yes, I want this strategy, but gosh, that sounds like a lot of work and very overwhelming.
Right. Well,
How does it work for you?
Right. Well, we have specialized software that helps us determine what a reasonable calculation amount for you would be. Again, as we've referenced before, we're going to go and confer with the CPA because they're the one that are going to file your taxes for you at the end of the year and make sure that they agree with that, with those calculations. But kind of the idea is, as I'd mentioned earlier, in 2023, a married filing jointly couple roughly can have around $120,000 of gross income and still be in a 12% income tax bracket. So kind of the thought process is if you're at $90,000 in gross income today, you possibly have the ability of roughly $30,000 that you can take from a qualified plan, pay 12% federal tax on that today. Yes, there are state taxes involved too, but 12% federal, and then you have the ability either to pay the tax bill out of that conversion or out of cash flow, just whatever happens to make the most sense for your situation, which we can help you figure that as well. Move that money either into a Roth IRA account, where now not only does it grow income tax free or income tax deferred, but if we also follow the rest of the rules that are there, that money can come out income tax free in the future. The benefit there is when those brackets increase at some point in the future, if I do need greater income flow in any one year that moves me into the next tax bracket, I now have a pot that I can go reach into where my assets aren't depleted by 25 to 35%.
Exactly.
I can just take out the dollars I need to go make the purchases that I'm looking for.
And what's beautiful about that is because you've already paid the tax, once you do the Roth conversion, then when you need that money, you're not having to pay tax on it, right?
I have greater control over my tax situation.
Right.
Retirement is the other interesting part, that it's the one time in life where you may have the ability to actually write your own tax bill.
Yes.
Yes.
I think a lot of people would enjoy that, right?
Yes,
Being
ma'am.
able to be
That's
in
right.
control of that without feeling like, gosh, there's nothing I can do about this. I know that there's another strategy that you employ for your clients as well, so tell me a little bit about that one.
Well, there's, with Roth conversions, those are what's in the news a lot. But we also use strategies where we take qualified money and take it out of the account, pay the taxes on it at that time, and we use what are called index universal life insurance contracts that grow in cash value, and you can actually not only does it pass death benefit on to your beneficiaries later on tax-free, but there's also cash benefits to it. And as we mentioned on earlier episodes, oftentimes there's long-term care benefits that can be gained from doing that. But it's another tool to use and another asset class that we use in those situations.
So we're just coming up with all sorts of acronyms today. Well, we're not coming up with them, but we're sharing them, right? So that would be an IUL.
An index universal life.
Exactly.
Yep.
So who would be an ideal candidate for something like an IUL?
Well, primarily it's going to be someone who has probably a larger than average IRA account, okay? And then we have a income need that's probably already being met by other sources, or we have excess income dollars that are there. That's going to be the primary. Number one, you got to qualify health-wise, and so we need to be at least reasonably healthy in most cases. Here's the other one advantage that may come from taking the money out of a qualified account is all IRA accounts and qualified accounts are only coded to one Social Security number. I'm the only one that can utilize those dollars directly. When we take that out, we may be able to use a joint life policy or something of that nature where we can have benefit offered to more than one of the spouses as well.
Right. Wow. Gosh, so many strategies to be able to employ. And I know that's what you do for folks, right? Is sit down with them and figure out what would be the right tax strategy for them.
That's correct. And we'd like to offer that tax analysis strategy for you. We'd love for you to contact us if you have questions or concerns about your taxes and you don't understand them. We would love to help guide you through those. Please call the number on the screen or click the QR code and set up a time to come in.
Mark, Dale, thank you so much. To our viewers at home, we are going to take a quick commercial break, but this is a great opportunity for you to call the number on the bottom of your screen, 866-724-3893, to get your complimentary tax analysis from Dale and Mark and the team at Retire Path Wealth. You're also welcome to take out your smartphone. Simply scan that QR code in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few simple questions, and then a member of the Retire Path Wealth team will reach out to you to schedule your complimentary appointment to come in and get your complimentary tax analysis as part of an overall comprehensive holistic financial plan. We're talking all about how to minimize your taxes and how you can pay less to the IRS in retirement. Stay with us. We'll be back right after this.
When was the last time you saw your financial professional? Are you getting the most out of the strategy that was created for you? Although you've done a great job finding someone to help plan for your future, are you 100% sure that you were given the right strategy? We can help answer these questions and more with a complimentary second opinion evaluation. We will take a look at what you have in place and then help determine if you're well positioned to get the most out of your future retirement income. In the event that it is not, we can help by making suggestions and showing you how to get on the right path. You wouldn't get just one opinion when it comes to a major health decision, so why would you treat your most important financial decision with such disregard? Call today for your no-cost, no-obligation second opinion evaluation to see if you're getting the most out of your retirement income plan.
Welcome back to Arkansas Money Talk. I'm Kristen Oakley here with Dale Colclaser and Mark Smalling from Retire Path Wealth. We are talking today all about taxes and how you need to think about engaging in strategic tax planning for your retirement. The reality is a lot of folks think, I've saved up all this money in my traditional IRA, my 401k, my workplace retirement plan. Yay, I have $1 million. I'm going to be fine, right? They forget about their silent business partner. And I've heard it said that really these qualified plans, these tax deferred plans, are really an IOU to the IRS. Am I right?
That's correct.
Yep.
That's definitely one way to put that, because I've heard even some of the better known tax people out there that are all the time out talking about this topic, basically addressing the fact that you just mentioned. I've got $1 million in an IRA account. Well, really, what you have is about 60% of that money is yours.
Yes. Yeah. Exactly. A lot of people just don't realize that. I feel like a lot of times with taxes, people are playing a game that they were never given the rules to, and the rules are constantly changing. And so I know that you stay on top of this for folks to really help develop strategic tax planning as part of an overall comprehensive financial plan. Right. So again, what are some of the key things that folks really need to be thinking about as they are nearing and approaching retirement as it relates to tax planning for themselves?
Well, one of the things that people definitely need to address, just as you say, is just the basic tax planning itself. It's one of the things that we've realized over 20 plus years in this career is that we can't control the market.
Right.
And so there's some things in this process that are just simply out of our own control. But the one thing we do know is what tax brackets are. We have the ability. So we have always developed a belief that if we can find a way to help save minimize the effect of taxes on our investments, we're going to improve your rate of return, even if nothing else happens from there.
Right.
So many times that's the focus with most investors when they come in, is basically oh, what did I make? We want to shift that focus on what do I get to keep.
Yes, exactly.
In many cases. So kind of the idea is implementing a strategy where we proactively spell out in a written income plan exactly which accounts we're going to use at which times throughout our 20 to 30, 40-year retirement situation, and we can actually help calculate in the future what those tax bills will be. Again, as we've always mentioned before in previous episodes, as we plan for what we know what tax code is today, we know what it's supposed to be, but we do actually have systems where we can go in, and if you have a strong belief as to what taxes are going to be in the future, we can actually help illustrate that for you if those changes did come to pass as well.
That's so helpful to know. Go ahead.
Well, no, I mean, when we're looking at all these things, we're looking at we were talking about Roth conversions earlier.
Yes.
It's also a big reason why we talk to people about their Social Security benefits and actually deferring those to a later time to give us more room in the bucket, because they're all buckets, all the tax buckets that as we're looking at them, and we're just trying to make sure that people have the most tax efficient dollars, and as Dale mentioned earlier, that you really can write your own tax bill,
right?
And if you do these things, kind of help immunize yourself against future tax changes.
Absolutely.
And that's
right. And Chris, one of the biggest challenges is so many times the discussion of this topic is so counterintuitive to what people have always believed.
Yes.
Oh gosh, let me defer all that money and I'll pay all those taxes later.
Let me lower my tax liability this year,
yes,
right?
That's right, without thinking of the consequences that happen in the future. It's so common that we'll have someone come in and they've already retired, or they're literally retiring next month. And I'll say, what's your plan for income for when that paycheck stops?
Right.
And they'll say, oh, well, I have savings. And it's like, okay, those are literally today the last dollars you probably should be spending in most cases. That's the one we want to set aside.
Right.
Because as we've mentioned, and I really focus on that 12% income tax bracket, because that's just where the vast majority of Americans fall.
Right.
Is the reality of it is, if I get to that $120,000 in gross income and I need to go $10,000 over that, I don't want that change to go from 12 to 22%, because that's literally a 40% increase in tax liability on those dollars.
Right.
Now I can go use those dollars that are set aside in savings, then those non-qualified accounts, or possibly even the Roth IRA, or my cash value life insurance if I have it in place, so that I don't have that shrinkage on my spending power.
For sure. So I know you've already alluded to this, but just to break it down, let's say someone's approaching retirement and they have 3 types of accounts, right? Tax deferred, taxable, and then tax-free. So if you're generating income for someone in retirement and you're developing that strategy, typically, and I know no one size fits all, everyone's situation is different, what is typically the order from which you withdraw money from each of those 3 types of accounts?
Well, it actually depends on the year, and that's, and especially when you're doing if you're doing Roth conversions over a few year period, and so we actually look at their income planning on an annual basis.
Okay.
Where we're actually deciding where money comes from based on that year's situation, based on how different accounts may have performed in that year. So it's not a set it and forget it, which I
Right.
think is what so many people do.
Yes. Well, that's kind of what we've been taught to do in the accumulation years, right? Just save, set it, forget it, right? Or a lot of people are in target date funds, things of that nature.
Right.
But what you're talking about is active management, and that's what you do for your clients.
Well, and not just active management of investment accounts, but active management of that tax planning. I
Absolutely.
appreciate the fact that you've alluded to that, because there's this academic theorem out there that, oh, you just take 4% of your income.
Yes, that's a historical rule, right?
Yeah,
Yes.
I can take this 4%
Right.
and it flows out, and I ask people all the time, and then the first question is, well, how much is that? And they get this blank look on their face like, I never thought about that. You know, and especially if you're been the breadwinner and the other spouse is the one that actually takes care of cash flow. I said, so have you explained to them that that's going to be a variable number every single month? Because my
Right.
bet is they've been planning on a budget for years in the past, and now you're going
Right.
to change that?
Yes.
How does that process itself work?
So to that, just a fun, quick question. I know you meet with a lot of couples, right?
Right.
So how is it that are often people not on the same page, and then you kind of help them get on the same page in terms of planning for their retirement in this way?
We try.
Yes. No small task, I'm sure, right?
Yeah, sometimes it's no small task. It's because usually there's one that handles more of the finances than the other.
Yes,
And it could be the husband or the wife. I mean, it's not always gender specific. We see
course, yeah.
we work a lot in the medical industry, and we have a lot of nurse clients, and we see a lot of those that kind of drive the financial decisions. And
Well, and the other big reason you want to have both on the page is statistics tell us there's going to be one spouse that's going to outlive the other by 3 to 7
Absolutely.
years.
Yeah.
So if that person's not been involved in this process,
Right.
you know, they're probably not going to be at the stage of their life where they're going to want to go learn all this when it becomes the necessity. So it's better to get ahead of that earlier. The other is not just are you going to be making those decisions by yourself, but now your tax bucket just shrunk in half.
Right.
Because
Yeah.
now you're filing single, not married filing jointly any longer.
Well, I know you have a very special offer outside of just your Discover Your Retire Path that you offer to folks. So talk about that, because it's tax specific today, right?
Yes, it is. We actually have, and hopefully it'll be coming up on the screen, where you can actually do a tax calculation of what your tax liability is on your qualified plans. We'd love for you to shoot that QR code and plug your information in. You may be surprised how much you actually could owe on your qualified plan.
So you're inviting people to test their retirement taxes, right?
That's exactly
and you will
right.
walk them through every step of that process.
Yes.
Dale, Mark, thank you so much. To our viewers at home, thank you so much for watching. We encourage you, find out what your tax liability will be in retirement so that you can minimize it. Call the number on the bottom of your screen, 866-724-3893. We'll see you next time.